Many of the mistakes that we find in the TSP arise from just not really understanding how it works in the first place. That's why my goal in this video is to break down one, how contributions work, two, how the funds inside of the TSP work, and then three, what some of the common mistakes that we see are and how to correct for those. Before I can jump into contributions themselves, I first have to talk about government matching. These are the contributions that the government will do for you, especially if you contribute yourself. The one exception to this rule is if you are active duty and under the high 3 retirement system. In that instance, you don't receive any government matching, meaning the only dollars that will ever go into your TSP are what you contribute to it. If you are instead under the blended retirement system, or you're a federal employee under the federal employee retirement system, then you'll receive 1% guaranteed, meaning that even if you don't contribute, they will contribute 1% of your salary for you. Dollar for dollar matching on your first 3% of contributions, and then 50% of the next 2% that you contribute, meaning if you put in 2%, they'll put in 1%. So all in all, they'll put in the 1% guaranteed, 3% if you contribute 3%, and then another 1% if you go up to 5%. So this is a really convoluted way of basically putting in 5% if you contribute 5%. But this leads me to the first mistake that people often make, which is not getting the full matching. So if you are contributing 5%, the government will put 5% into your TSP for you. If you contribute less than 5%, then you'll receive less than 5% matching, and you'll never get that money back, even if you upped your contributions more in the future. Again, this is just free money that you can collect by contributing more to your TSP, which is something you should probably be doing anyway. The other thing of note is that if you are active duty, then you will change your contribution percentage by logging into MyPay and not into tsp.gov. You will change your allocation, i.e. how you're invested, by logging into tsp.gov, but your actual contribution percentage will be changed inside of MyPay. With those things in mind, let's now jump to the contribution limits. So we now know what we receive in matching from the government. Let's talk about what we should actually be contributing. And what you should contribute is a personal decision that comes down to your personal life goals and aspirations. But what you need to know is that, one, you can do contributions either pre-tax or Roth. Pre-tax contributions are contributions that go in before they've been taxed, meaning if you earn $100,000 and you contribute $10,000 pre-tax, you're only going to pay income taxes on $90,000 that year. So again, this money will go into the TSP pre-tax. The caveat to that is when you invest this money, it grows, and you go to withdraw this money down the road, you will then pay taxes, income taxes, on your contributions that you made originally, that $10,000, plus on whatever it's grown to. So you will end up paying these taxes just down the road. You're simply deferring this money. It is pre-tax, not no tax. The other option is Roth. This is where you put in money after tax. So in that same example, if you earn $100,000 and contribute $10,000, you would still pay income taxes on $10,000. It doesn't reduce your taxable income. However, that $10,000 as it grows would all be tax-free. So when you withdraw in the future, you withdraw your principal, which you've already paid taxes on, and all of the growth tax-free. Again, what you should be contributing is a video for a future day, plus it depends on your individual scenario. In terms of how much you can contribute, the maximum amount that you could contribute if you wanted to, if you're under age 50, then you can contribute a maximum of $24,500. When you contribute, you don't actually contribute in a dollar amount. You assign a percentage of your salary to put in. But if you know a dollar amount that you'd like to contribute, maybe it's $10,000 like in our previous example, simply take that $10,000, divide it by your salary, and that's the percentage that you should be contributing. If you are age 50 or older, or you're turning 50 this year, then you can contribute an extra $8,000 for a total of $32,500. These are what's known as catch-up contributions. Catch-up contributions are larger for those that are 60 to 63. If you're 60 to 63, instead of $8,000, you can do an extra $11,250. These are the total amounts that you can contribute. So again, whether you should be doing pre-tax contributions or Roth depends on your situation and your goals. How much you should be contributing also depends on your situation or your goals. This is where financial planning comes into play and figuring out which you should be doing and how much. But now you understand what the government's matching, you understand your contribution options. Again, make sure that you go and look at what you're contributing and how much you're contributing and adjust that based on the financial planning that you do. But now that we know about contributions, we can now talk about once the money's inside of the TSP, what do we then do with it? Well, of course, we invest it, but how do we invest it? So let's talk about the funds that are inside of the TSP. So if you don't know, there are 5 funds inside of the TSP. These are more or less, there is one obscure thing that I can talk about in a future video, but these are more or less the only things that you can invest in inside of the TSP. The G fund, the F fund, the C fund, the S fund, and the I fund. Now, this is a pre-made portfolio that has percentages assigned to each of these funds, but I'm just using this as a graphic to lay out each of these funds while I talk through them. Let's start with the G fund. The G fund, G in this instance stands for government securities. G fund is specially issued short-term treasuries to the TSP. So what does that mean in English? Well, the G fund is, again, short-term treasuries. So these are government bonds that have short maturity dates, meaning less than 1 year. So it's government bonds that mature in less than 1 year. They're backed by the government, which makes them a little bit more, it reduces the credit risk of them. And they're specially issued to the TSP. What does that mean? It means that they're not traded on the open market. The TSP is not just buying these off of the market. They are specially issued from the government to the TSP. The big advantage of this is it creates less price volatility. When something's traded on the open market and there's buyers and sellers, it's constantly moving the price around as buyers and sellers try to agree on a price. Since the TSP is the only one that owns these, it's not buying and selling with itself constantly, and this reduces, again, the price volatility. So the G fund is a very good place to preserve cash when you need to. So if you're going to be using funds in a short time period, maybe within the next couple of years, the G fund is a good option because the G fund has never gone down in its history and it has much lower price volatility than what you might find in short-term treasuries on the market. Since its inception in 1987, the G fund has had an annualized return of 4.65%, which is great because it's slightly higher than inflation. So again, rather than keeping dollars under your mattress or in a checking account, this can be a really good option of protecting yourself from inflation since it's grown more than inflation without the risk of it going down, barring the government's collapse, basically. The next fund is the F fund, and F in this instance stands for fixed income, which refers to bonds. So again, the G fund are this special kind of treasuries or short-term bonds from the government. The F fund is long-term bonds, so bonds that have a maturity date longer than 1 year. These can be, again, government bonds, which just under half of the F fund is government bonds with this time long-term maturity dates. But it can also be corporate and non-corporate bonds with, again, long-term over 1 year maturity dates. These are all investment grade bonds, so it's not what you might have heard as junk bonds. And this has had an annualized return of 5.25 since its inception a year later in 1988. An important note about the F fund is that it does have negative years. So it does have a little bit more price volatility and a little bit more downside in certain years than the G fund does, but it has outperformed it by just under 1% per year annualized. The next fund is the C fund. So C in this instance stands for common stock. And this is a little bit of a misnomer, as you'll see in my explanation in just a second. But just know that C stands for common stock. The C fund is trying to track the S&P 500 index. It's trying to replicate it. The S&P 500 index is an index that tracks large U.S. companies. So the goal of the C fund is to invest in large U.S. companies, or also known as large cap companies. I say that calling it common stock is a little bit of a misnomer because common stock can also include small U.S. companies or international companies. But in this instance, that's what they refer to it as. So that's what we use. Now, the C fund has returned an annualized return of 11.17% in its inception in 1988 as well. This is the highest of all 5 funds, but just know that past performance doesn't indicate future success, right? Just because the last few decades, which this was created in 1988, which is a rather short time horizon. Just because the last few decades have been very good for large US companies doesn't mean the next few decades will. So just because the C fund has had a very good performance over the last few decades doesn't mean it's a reason to sell out and go all C fund in your portfolio, although it is a very good fund to have in your mix. The next fund is the S fund, and S in this instance stands for small or small capitalization. Again, a little bit of a misnomer because what the S fund is trying to do is invest in every other US company outside of what we just mentioned in the large ones. So instead of just large US companies, the S fund is trying to invest in mid-sized US companies and small US companies. That's why I say it's a little bit of a misnomer, because it's not just small companies, it's mid-sized companies as well. But just think any US companies that are not large US companies are not large cap companies. The S fund is a little bit of a newer fund, and it was created in 2001, and it has returned 9.33% since its inception. The last fund is the I fund, and I here stands for international. And the goal of the I fund is to invest in developed nations stock. So think of companies from developed nations often being countries in Western Europe or Japan or Australia, think countries like that. It does not invest in emerging nations. So a lot of Southeast Asia or parts of Africa or South America. It is only developed nations. But again, this is a great way to diversify because remember the C fund and the S fund are all US companies. Okay, so those are the 5 funds that are inside of the TSP. Again, what I'm showing here is one of the pre-made allocations where it will give you a percentage for each of those, but you can go in and choose to invest a percentage into each of those funds. Outside of the individual funds, the next option are the life cycle funds. And what the life cycle funds are funds that are pre-made for you. They're what's called a target date fund, meaning you pick the date of your goal, or which is often retirement, but whatever your goal is that you're investing for, you pick the date that will occur, and then it creates an allocation mix for you based on that. So what this chart shows, which TSP puts out almost every year, and this is from 2025, so it is a little bit old at this point, but what this shows is the allocation of each of the life cycle funds that exist. And all that the life cycle funds do is invest in those 5 funds that we just talked about. If we take a look, and I'm covering up some of them, but if we take a look at the later ones, 2075, which is behind me, 2070, 2065, 2060, we can see that these are time horizons or dates that are very far out, 30 plus years into the future. For this reason, you'll see the allocations reflect that. So they're 51% C fund, which again was large US companies. They're 13% S fund, which is small and mid-sized US companies. And they're 35% I fund, which is international companies, and then only 1% goes to the G fund and the F fund. This is because when you have a long time horizon, you don't mind the volatility in the short term as much. What you're seeking is the highest long-term returns. And again, if we look at the 5 funds, the G and the F fund return the least because they're short-term treasuries or bonds, which don't tend to grow as much as equities in the long term, like stocks, either US or international. You'll see as we move closer to the present, so as we go to the right on the graph, we see the 2050, the 2045, the 2040. As we get closer to the present, you can see that these target date funds or these life cycle funds start incorporating more and more G fund and F fund in them, especially G fund. The reason for this is, again, as something gets closer, as we have a shorter time horizon, we do start caring about that volatility in the portfolio a little bit more. And introducing the G fund and the F funds, which are much less volatile, stabilizes that portfolio. And you can see the closer and closer we get down to the 2030 and the L income, which just means you're currently taking income from the portfolio, start getting to where they have a lot of G fund and a good amount of F fund in them compared to the rest of the funds. The other important thing to note about the life cycle funds is that they are not static. They change over time as those dates approach. So if we take the L2055 fund, for example, which is all stock for the most part, C fund, S fund, I fund, and then 1% of the others, it would not stay like this as we approach 2055. 5 years from now, the 2055 fund would look like the 2050 fund. It would slowly morph into that 2050 fund. This is because as that date gets closer, we want to be in a more conservative allocation. So with all of these things in mind, here are some of the common mistakes that we see with doing an allocation in the TSP. And again, your allocation has to be determined on an individual basis. So I can't say in this video, and I can't give a recommendation of how you should invest your TSP. But here's some of the things that we find that people do that are often not suitable for them. One, we find people picking multiple target date funds. This could probably happen for a couple of different reasons. Maybe they feel that they have different goals and they're trying to put things into buckets, which could be a reason for doing that. Maybe they feel that they're trying to diversify more, which, as we've discussed, each of these funds holds the same thing. They hold the 5 individual funds, each of these life cycle funds do. So you're really not diversifying more. That would be a mistake, likely. Or one thing that we find causes it is when you go into tsp.gov and you go to change your allocation, you can change both your current allocation and your future allocation, meaning what you contribute in the future, how does that get invested? So what I believe happens to some folks is maybe they're in the 2050 fund. They say, hey, I actually want to retire a little bit sooner. They go in to change it to the 2045 fund, but they don't change their existing balance, what they've already contributed to. So that stays invested in the 2050. And then every contribution they do in the future ends up going to that 2045. So then they get this weird mix, and you end up just making one of the funds that's in the middle. If you had half 2060 and half 2030, you just have one of the ones that's in the middle, so you might as well just invest in one of the ones that's in the middle anyway. Again, not that this would be inherently wrong. You would have an allocation, it would just be blended between two, but it does make it harder to track what your actual allocation is, and it may change in a way over time that you didn't expect or you weren't wanting. So having multiple life cycle funds, or life cycle funds and individual funds for that matter, can make it much harder to manage your TSP and lead to some pretty funky, undesirable allocations in the long term. Another common mistake that we see is not picking the correct date for the target date funds, or the life cycle funds in this instance. If, for example, you're going to want to retire in 2050, but maybe you aren't actually going to withdraw from your portfolio for the first 5 years of retirement, it may be a better idea to select the 2055 fund. Again, I can't give the recommendation. That depends on your individual situation, but just know that you should be picking the target date that lines up with your goals. And unfortunately, one of the shortfalls of using target date funds like this is that they're not very individualized in the first place. So you're going to see that everyone with a similar time horizon is grouped into one allocation. And we know that people differ in their risk tolerance and their risk capacity and how they want to invest. So just know that going and investing in a life cycle fund may have you invested different than you really want to be. In that case, you could try to alter it by picking a different life cycle, or you could select individual funds. Just know that you would have to manage that and update that regularly, especially as you get closer to some of those goals. So that is the skinny on the TSP, contributions, matching, allocation. If you have questions, of course, leave those in the comments and I'll try my best to answer them. In future videos, I'll likely go through some of the more complex features of the TSP, like maybe the mutual fund window, or perhaps the new in-plan Roth conversions that they've enabled, or even what to do with your TSP once you're no longer an active employee, what your options are there. So this has been the basics on how the TSP works. Thank you for watching.